The financial world is bracing for a potential seismic shift as a highly placed advisor to the International Monetary Fund has reportedly outlined a new strategy that could lead to the revaluation of the Vietnamese Dong. This revelation, which has already started to send ripples through currency markets and investment circles, marks what insiders are calling one of the most significant developments in Southeast Asian monetary policy in recent years. If implemented, this strategic pivot could not only alter Vietnam's financial landscape, but also reshape regional trade dynamics and capital flow structures across Asia. According to sources close to the matter, the IMF advisor's remarks, made during a closed-door briefing with policymakers and international financial institutions, suggest that a controlled, strategic revaluation of the Dong is being considered as a measure to reflect Vietnam's strengthening economic fundamentals. While the exact timeline remains unclear, the plan reportedly involves gradual upward adjustments to the currency's value, potentially beginning within the next fiscal cycle, as a means to better align the Dong with Vietnam's current account surplus, rising foreign exchange reserves, and robust export performance. Vietnam's economic trajectory over the past decade has been nothing short of remarkable. Once reliant on foreign aid and heavily dependent on low-cost manufacturing, the country has transitioned into a burgeoning industrial economy with growing clout in global trade. Foreign direct investment continues to pour in, driven by Vietnam's political stability, skilled workforce, and strategic positioning as an alternative manufacturing base to China. These structural strengths have not gone unnoticed by international observers, who point to the country's relatively low debt-to-GDP ratio and expanding middle class as indicators of long-term macroeconomic health. Behind closed doors, IMF advisors have reportedly voiced concerns that maintaining an undervalued Dong could distort trade balances, attract speculative inflows, and strain the credibility of Vietnam's monetary framework. With inflation under control and GDP growth projected to outpace regional peers, the conditions for revaluation, according to those privy to the IMF's internal discussions, are becoming increasingly favorable. The proposed strategy is not expected to take the form of a dramatic overnight revaluation, which could destabilize markets, but rather a calculated and phased recalibration supported by capital controls and coordinated policy measures. Market watchers are already recalibrating their models. Currency traders in Hong Kong and Singapore report growing interest in Dong-denominated assets, while institutional investors are closely monitoring developments for signs of official confirmation. Although the Vietnamese central bank has yet to issue any public statement, a noticeable shift in its foreign exchange operations has been observed in recent weeks. Analysts point to smaller, more frequent interventions in the currency markets, potentially indicating a soft preparation for a more flexible exchange rate regime. The implications of such a move are profound. A stronger Dong would not only enhance the purchasing power of Vietnamese consumers, but also redefine the country's trade dynamics. Imports would become cheaper, potentially lowering input costs for manufacturers and easing inflationary pressures. On the flip side, exporters, especially those reliant on razor-thin margins, might face increased competition unless productivity gains can offset currency appreciation. This could, in turn, accelerate the country's shift toward higher value-added production and services, in line with its long-term economic development plan. For regional economies, Vietnam's potential revaluation strategy poses both challenges and opportunities. Neighboring countries with export-led economies could feel the pressure to follow suit, particularly if their currencies begin to appear artificially cheap in comparison. This could spark a broader trend toward exchange rate normalization in Southeast Asia, especially among economies that have thus far maintained competitive devaluations to support growth. At the same time, a stronger Dong could attract capital inflows to Vietnamese equities and real estate, diverting investment from other emerging markets. International reaction to the IMF advisor's remarks has been cautious but attentive. In Washington and Brussels, policymakers are reportedly studying the potential geopolitical implications, particularly in the context of shifting global supply chains and the West's ongoing efforts to diversify away from over-reliance on China. For multinational corporations, a revaluation of the Dong could alter cost structures and investment strategies, prompting a reevaluation of regional procurement, labor deployment, and pricing models. Domestically, the prospect of currency revaluation is already generating debate among economists and business leaders. Some welcome the move as a long-overdue recognition of Vietnam's economic maturity and global relevance. Others warn of potential unintended consequences, such as reduced export competitiveness and volatility in asset prices. The Vietnamese government, known for its methodical approach to economic reform, is likely to weigh these considerations carefully before making any formal announcements. One key driver behind the timing of this potential shift is the steady accumulation of foreign exchange reserves, which have reached record levels in recent quarters. This buildup, fueled by consistent trade surpluses and strong remittance inflows, has given the State Bank of Vietnam greater leeway to manage monetary policy without triggering currency shocks. The IMF advisor's strategy reportedly calls for the use of these reserves as a buffer to smooth out volatility during the transition, ensuring that market participants have confidence in the central bank's ability to maintain stability. At the same time, the move could serve broader strategic interests. As Vietnam seeks to deepen its integration into the global financial system, a more market-aligned exchange rate could bolster its case for inclusion in major currency indices and strengthen its appeal as a destination for long-term institutional capital. The IMF advisor is said to have emphasized this point, noting that improved transparency and currency convertibility are prerequisites for greater financial liberalization and investor trust. What remains uncertain is the exact mechanism through which the revaluation would be implemented. Experts speculate that the strategy may involve a gradual widening of the trading band within which the Dong is allowed to fluctuate, followed by incremental adjustments to the official reference rate. This would mirror the approach taken by other emerging markets that have transitioned from tightly managed exchange rate systems to more flexible regimes. The IMF has previously advocated such strategies as a way to build credibility and resilience in developing economies. As the story continues to unfold, speculation is mounting within financial circles about the potential timing of the first move. Some analysts believe that the groundwork is already being laid, with subtle policy shifts and behind-the-scenes consultations indicating that an announcement could come as early as the next quarterly policy review. Others caution that domestic political considerations and global macroeconomic uncertainty, particularly in light of ongoing trade tensions and fluctuating commodity prices, could delay the process. Meanwhile, the Vietnamese business community is keeping a close watch. Exporters are reportedly reviewing pricing strategies and exploring ways to hedge against potential currency fluctuations. Importers, on the other hand, are optimistic that a stronger Dong could translate into cost savings and improved margins. Financial institutions are preparing for increased demand for hedging instruments and foreign exchange products, anticipating a spike in client activity once the first policy signals are made public. On the international front, central banks and finance ministries are likely to monitor Vietnam's moves closely. Any significant shift in the Dong's value could have ripple effects across global currency markets, particularly in Asia, where exchange rate movements are often interlinked due to trade relationships and shared investor bases. A revaluation could also affect commodity pricing, particularly for goods in which Vietnam plays a key role in global supply chains, such as textiles, seafood, and electronics. There are also broader implications for the IMF itself. If the revaluation strategy proves successful, it could serve as a model for other emerging economies seeking to transition to more flexible exchange rate regimes without triggering capital flight or inflationary shocks. The advisor's remarks appear to reflect a growing consensus within the fund that managed data-driven revaluations can be powerful tools for economic modernization and integration. Still, skepticism remains. Critics argue that any move to strengthen the Dong must be accompanied by structural reforms to ensure competitiveness, particularly in areas such as productivity, innovation, and governance. Without these reforms, they warn, a stronger currency could expose underlying weaknesses and undermine export performance. Others note that global economic conditions remain volatile, and any abrupt currency shift could invite speculative attacks or sudden capital outflows. For now, the world waits. Investors, analysts, and policymakers alike are sifting through every data point, every official remark, and every market movement for clues about what's to come. While the IMF advisor's comments stop short of constituting an official policy directive, they offer a rare and valuable glimpse into the thinking of one of the world's most influential financial institutions. Whether the strategy is implemented in full or evolves in response to changing circumstances, one thing is clear: Vietnam is on the cusp of a major monetary evolution. As always, viewers are reminded that developments in the global financial system are inherently complex and influenced by a multitude of factors. While this report is based on real discussions and observed policy signals, the situation remains fluid and subject to change. Any investment or financial decision should be made with a full understanding of the risks and in consultation with qualified professionals. Stay tuned for updates as more information becomes available and as Vietnam, the IMF, and the world move closer to a potential revaluation that could redefine the future of the Vietnamese economy.